Before we get to that, you make the point, the reason why there is such opportunity for the individual is that in the investor world, you believe it's become more short-term focused, which means buy high, sell low.
That's a really great point. Big picture is that when you look back at what's happened over the last 20, 30 years, there's been more access to information, there's been more computing power, there's been more people going onto Wall Street, it's high-paid hedge funds and, proliferation of mutual funds and everything else. So there's a lot of smart people actually trying to beat the market, quote unquote. And so you would think that it would be getting tougher and tougher for individual investors to outperform the market. And what it turns out is our simple value factors have actually gotten stronger over the last 20, 30 years. And the reason for that is that the world has become much more institutionalized, meaning, I'll just tell a quick story I tell in the book, which was that in the late 80s, I had an investor in my partnership, one of the first fund of funds. And these are funds that actually pick managers, and you're asking them to find their expertise to pick the best managers, and they put that all together in a fund. And so one of the first that was put together in the late 80s, or at least the ones I knew about, asked to invest in our partnership. And at the time, I was writing quarterly letters, and that seemed to be fine for my investors. But the fund of funds said, well, we have to report more often, so could you give us monthly returns? So I said, sure, I'll tell you the monthly returns as they come in. And sure enough, after the first month that this fund had money with us, we reported back that we were up 1.1%, which we thought was pretty good. But I got a call from the fund of funds and said, well, we have a lot of other managers that do similar things to you, and the average one of those was up 1.2% last month. To what do you attribute your underperformance? And I politely told the fund of funds to call me back in a year. I probably should have told them to call me back in 4 or 5 years, but I don't think they would have stuck around so long. So I figured I'd settle for 1 year. But the world has become much more institutionalized since then. People look at daily returns, weekly returns, monthly returns. They get analysis over the month or the quarter. It's very hard to keep a long-term horizon when you're investing in the stock market. 4 or 5 years is a more reasonable time frame to judge anyone's performance. And
so you get hyperactivity, which research shows does not lead to better returns.
Exactly. So what happens really is that, if you underperformed in the last 6 months, year, or 2 years, people chase performance. So they take money out of you and put it to someone else. And another statistic I wrote in the book, which I think is the most telling, is if you look at the top performers over the last decade, the top 25% of managers that have outperformed, came up with the best record for the last 10 years, 97%. Okay, 97% of those top managers spent at least 3 years in the bottom half of performance. 79% spent at least 3 years in the bottom quartile of performance. And almost half, 47%, spent at least 3 years in the bottom 10% of performance. So all their investors left if they did that, but these are the ones who ended up with the best long-term record. Most people leave them. Most people don't stick around for long enough. One other thing I write up was the top, in the decade of the 2000s, that 10-year period, the top performing mutual fund was up 18% a year. The average investor in that fund lost 11% a year. That was the best one. Why is that? It's because every time the fund underperformed, people left. Every time the market went down, people left. Every time it outperformed, people piled in right after the outperformance. Right after the market went up, people piled in. So with all the investors' market decision, the average investor, average dollar-weighted investor in that fund over the last decade, the best fund, ended up losing 11% a year.
You make the point that if you go for value, and we'll define your definition of value in 1 second, over the last 10 years, 600-700 basis points above the S&P. Are you guilty of rearview mirror investing, saying what worked in the past will work in the future? We know with money managers that doesn't work.
Right. Well, if I had spun the computer a million times to figure out what might have worked, that is true. But we have a couple simple factors that we use. That's the way I invest in individual stocks. It's really looking at how much cash flow do I get for the price I'm paying. I don't use simple earnings. I use our own definition of cash flow. I don't use simple price. I use something called enterprise value, that we make all kinds of adjustments for debt.
Let's go to that. Define what you call price to cash flow.
Well, in the last book I wrote, I used EBIT, earnings before interest and taxes. For our new mutual funds, we actually go figure out what the real free cash flow is. EBIT it was a proxy, and it worked quite well in backtesting. We actually do the work ourselves and figure out what real free cash flow is. So if we have pension liabilities or tax assets and tax liabilities, we just really pick it apart. But the concept is very simple. It's, what is the real free cash flow of this business? And we're not looking forward. We actually look backwards. So we can talk about that in a second. How can you make money by looking backwards? Because the value of a company comes from its earnings going forward. So if you have something that you can look at history, right? Reading history books shouldn't be able to make you money. Well, here we're just using simple factors based on what's already happened. And we can talk about in a second why that works. But we're looking at trailing free cash flow to the price we're paying, the all-in price we're paying, including all the liabilities of a company. And the other thing we use in the mutual funds is really just our definition of return on tangible capital. And if you read through all of Warren Buffett's letters, he really focuses very keenly on how good a business it is. And one of the factors that he looks at, most importantly, is a business that can earn high returns on tangible capital.
Explain why looking at the past is predictive of the future, and then get to the number of securities you should hold. First, why is the past predicting the future?
Right. That's actually a wonderful question, and frankly, a very logical and obvious question to ask. How can you look backwards and then figure out what's going to happen in the future? And in fact, we're really not doing that. What happens, we were talking about before, is how people have a very short-term horizon. And, the big secret for the small investor is that they can keep a long-term horizon. So why would the market allow us to buy a company cheap relative to its earnings? We called it an earnings yield. In other words, why would we get a 15% earnings yield from one company and only 5% for another? Why is the market giving us this bargain? Generally, the companies, if you look backwards, that earned a 15% earnings yield, most people don't think that'll continue in the future. At least the next year or two won't be as good as their most recent past. And so they're willing to sell it to you cheap relative to its past earnings. So they think the next 1 year or two will be down from where it is. So they allow you to buy it at a bargain relative to past earnings. So these are you're buying all out of favor companies. They earn high returns on capital. You're getting a high earnings yield, but people are worried about the next year or two that they won't be as good. So they discount.
So Obamacare comes along, dump the healthcare stocks.
That's a perfect example. Healthcare stocks show up on our list now because everyone's worried about what's going to happen, under Obamacare. All kinds. We have a company called GameStop that keeps coming up on our list because everyone thinks it's the next Blockbuster. They sell games.
So look at the news and companies that look like they're going to get a hit.
Well, we really do it by we really do it by the numbers. So if you get a high earnings yield now, that means there are very low expectations for the companies that you're buying. Even though they're getting high earnings yields, there's low expectations for the future.
So you're not buying a company that's going broke.
Exactly. You get high free cash flow now. You think the next year or two might not be as good, or there's a lot of uncertainty. So you buy them with low expectations built in, and if they do a little better or a lot better, you have the chance for asymmetric returns on the upside. And those are precisely the stocks that institutional managers who worry about doing well in the next year or two systematically avoid and overcompensate for that because they don't want to be there. So if there's uncertainty about the business, or you kind of know it's not going to be as good in the next year or two, institutional investors systematically avoid those stocks. You don't pay a lot for anything. So if they do a little better or a lot better, you have a chance for asymmetric returns. If the low expectations come in, you didn't pay for high expectations. So hopefully you don't lose very much. So if you don't lose very much on the companies where the good news doesn't get a little bit, the news doesn't get a little better than expectations, and you make a lot on the companies where it's a little better or a lot better, on a surprise, you can end up making a lot of money. And it's very systematic. And those factors have actually gotten stronger because of the institutional bias now in the market.
Now, as you know, sometimes even though you do brilliant analysis, a stock can still become a dog and stay a dog. Yet you say you get a better return with relatively handful of securities, 20 to 30. Yet you also have a fund where you can offer much more, but you get less of a yield. Why would 20 or 30 do better than, say, 500?
Okay, well, we really think of it as underwriting this systematic risk that people are avoiding this stock. So if you insure 1,000 lives next year, you probably could take a pretty good guess at about let's pick a number, 6% aren't going to make it through the following year, and you can underwrite that risk. It might be 5.8%, it might be 6.3%, but you can pretty well guess what that number is going to be. When you underwrite 100 lives, one or two guys going one way or the other could give you a different outlook. Now, over a 10-year period, and you can actually do a little better underwriting with those 100 lives. You can not insure some and insure others, and maybe do. But still, 2 or 3 or 4 people going the wrong way in any particular year can really change your results and your expectations. So we look at it the same way as stock investing. With a more concentrated portfolio, over time you could probably make 2 or 3 points more a year, but you probably have to wait around 5 or 10 years for those extra 2, 3 points. And in the interim, it's going to be a very volatile ride. We can actually do it with 500 or 800 stocks with much less volatility. We do 2 or 3 points less, still beating the market by 600 or 700 basis points a year. But the key is, what will you stick with? Most people can't live with the volatility. When they underperform for a year or two, they leave. So if you know yourself and you truly have a 10-year horizon, it may be a better bet to take the more selected portfolio. We actually have a mutual fund that has a more selected approach. But it's really for people who are a little bit braver, meaning they understand what we're doing. We're buying above average companies, but only when they're available at below average prices, and that makes sense to them, and they're willing to stick it out for 5 or 10 years. Most people aren't like that. Most people would rather have a bit of a smoother ride, give up a point or two in return, still with excellent returns, and take a more diversified approach. So there's something for everybody. They both make sense. The trade-off between the extra risk you're taking, which I don't know.
So you have 4 relatively new funds today. One, in effect, your version of a domestic index, your version of an international index. Somebody said that's not index, that's quanting. You say you don't care. It's the principle that counts. You have 2 other funds that are more of a roller coaster, or could be more of a roller coaster.
A little bit more of a roller coaster, but yes, they have between 75 and 100 stocks in general. Excuse me. So we have, international and domestic index-like funds, and then we have international and domestic more select funds with 75 to 100 stocks in general.